Hi, welcome to Invest Today. Let us understand what is open interest from the basics to the advanced level. So, today I will show you what is open interest, how to analyze it, what is open interest, how it increases, how it decreases, how you can use open interest to make an informed decisions, understanding the supports and resistance where the open interest is built up. So let us start the by understanding the open interest. So today we will learn all about the open interest. Stay tuned till the end so that you will get a complete understanding of what are all the things you should know about the open interest. So the first thing is let us understand the what understanding the open interest. Open interest, if you see the definition, open interest is a total number of outstanding or open contracts at the end of the trading day. So, open interest reflects the total number of contracts held by the traders or investors in the market. So, you might have seen in the option chain. So, let us understand the first theory part a bit, then I will show you in the practical scenario how exactly there are many tools which will give you a graphical representation of how OI changes everything. Before that, you need to understand what exactly the definition is and what are all the parameters, the significance of OI. Then only you can understand, right? So open interest is the total number of outstanding contract at the end of the day. So if a person A buys one contract and if a person B sells one contract, that is where the open interest will be one. So let us understand how open interest changes. So open interest changes when contracts are created or existing ones are closed, right? So let us take an example here to make you easy to understand. If A buys one contract and B sells one contract, the open interest will be 1 and the volume is also 1, right? So one contract bought and one contract sold. So one the open interest will be 1. And again, the person C buys 3 contracts, say suppose, and D sells 3 contracts. So the open interest will become now 4. So this is 1 and here 3 contracts added the 4. The volume also increased to 4, right? So if A sells his or her one contract and D buys one contract. So there is a reduction in open interest. You can see the A buys one contract here and he is selling one contract, and another D is who has sold 3 contracts, he is buying. So the open interest reduced. So one open interest got reduced. So open interest came to 3, but the volume went to 5. So that is how if E buys 2 contracts from the C. So C he is having a contract. Number E buys 2 contracts. Who again C sells 2 contracts. So यहाँ पे what happens? So there is a unwinding of the open interest. So E is buying from C. That means he is covering off who sells 2 contracts. So here it is a reduce and the open interest remain intact even though there is a new buyer in the contract. So as the C has unwinded his position, the open interest will remain the same, but the volume increases. So it works like that. It is a continuous process and it will be keep changing. So in simple, it is like open interest means a person one contract who is buying and one person who is selling. Then it will be one open interest. So let us understand in detail how it is changes versus the volume. What is the difference? So volume reflects the total number of trade during a specific period, whereas open interest shows the total number of outstanding contracts. This I have taken this graph in a live position today. Okay, today is the Nifty's. This is Nifty futures graph. I will show you in detail, but let us understand. here versus the volume. Volume reflects the total volume of trade. See, if you see here, the total volume has increased, but the open interest started coming down and the market price is also coming down. So this clearly indicates the bearishness. Okay. So volume only reflects the total number of trades, but the open interest will have the figure of outstanding contract. Here, if you see here, the open interest graph is falling. So the outstanding contracts are falling. So there is a huge unwinding here happening in the volume increases. That is how the market, you can say that it may fall. So that's how the volume increases. I will show you how you can analyze the data. There are only four possibilities here. I will show you in the next how to interpret the OI. So bullish and bearish implications. Increases open interest may signal market strength, while decrease in open interest might indicate weakness. So as you can see, if there is an increase in open interest, so there is a more money coming into the market. So if there is a decrease in open interest, so there will be a mild weakness. So for example, if you can see this is the Adani port. See here, the open interest, this is open interest graph. As soon as the open interest increase, okay, the percentage of change, the volume, as per the volume also increase, the market tends bullish. So this is how you can interpret the open interest whenever it is in live market. Nowadays, open interest can be tracked for every 5 minutes, 10 minutes, 15 minutes, 30 minutes, and historical data also. You can see which are all the options, or even in the stocks, futures, which is there in there. By looking at the open interest, you can easily analyze what is the strength, whether it is weak or strong. So let us understand here. See, whatever we learned there, it was might confusing, right? इतना आसान दिखता है, उतना आसान नहीं है open interest का. मगर I will make it simple. By if you look at this chart, how to analyze open interest. So increase in open interest means the new money is flowing into the market. See here, to make it simple, you can go through this chart. If there is a, this is the price and this is the volume and this is the open interest bar. So if the price is increasing and the volume also increasing, the open interest also is increasing, then that is a strong bullish trend. It's quite simple, guys. You can see here the practicality. I will show you in the live market as well. So if the volume is increasing, okay, the price is increasing, the open interest also is increasing, then it is a strong bullish trend. Many times what happens, the price may be moving, the volume comes down and the open interest comes down. So that is where the bullish exhausted. That is the weaker trend you can think of. So if the price is increasing, volume and open interest are, it's all interrelated. If the volume comes down, open interest comes down, that is a weaker trend. So the another scenario is where the price also falls, the volume also falls, open interest also fall. So bulls becoming strong. So okay, that is where the open interest, if it comes down, the volume comes down, price also comes down. Bulls are becoming strong. So the another aspect is when the price is coming down, the volume is increasing. Okay, the open interest also increasing. That is where the bearish trend starts. Okay, see when the see, it's all about the price falling, volume also falling, open interest also falling. You can see lot of put open interest will be increasing. So that is a bearish trend. Okay, so this you have to keep it in mind. This is a simple way where four aspects you have to see when the price, volume, and open interest. All these things you can have it in the graph and analyze the data, and you can see how actually it will give you an insight of what market is about. So I hope everyone understood here. So if there is any doubts, you can just comment me on the comment box. So going forward, so let us understand the importance of open interest. See, market depth indicator, see, open interest can provide insight into the market strength and potential price trend. If you can see, if you have an historical data of the open interest. So this graph is also I have downloaded from Sensible with an historical data. See, if you see here, the I have taken from October 30th to January 20th. What is the historical data? What it has been doing here. See, if you see here, 20,600 put 20. These are all the put side. Okay, these are all the call side. I will show you. Don't. So let us understand the theory first, and then I will go and explain in the sensible and other platforms to make you clear understanding. So this is an historical data where the puts, if there is any unwinding, if there is any addition of open interest, you can see historical data and gauge the market where exactly the market can be in a range bound. Okay, so let us understand what is the formula for open interest is very simple. Total long positions plus total short positions. So that is how you can get the open interest. So once you understand all these things, how will you apply for a in a practical situation? So traders and analysts, so we use open interest to gauge market sentiments and make informed decisions. You might have seen me, I have been posting in the group like where the open interest are highest, and in the expiry day it matters a lot. Like you can easily gauge after 3 o'clock where exactly it is like where exactly it is going to close. That is where, irrespective of the price movement, sometimes when you have an open interest data, you can check it out like with the volume and the open interest strike rate. You can easily hold on till the expiry to make good profit. So what are the risk and limitations? So it doesn't mean that like open interest will give you the 100% idea of where the market closes. No, relying solely on open interest of the market might have a limitations and risk. There are instances where open interest didn't actually predict the market movement because at the last, because open interest keep changing every second. So you might have seen like in the options trading, so every second happens a trade. So there is an open interest change, continuous open interest change in all the strike rates, whichever either in the Nifty or in the stocks. Whenever it reaches the strike price, it becomes at the money and out the money. Out the money also will have lot of impact, the gamma effect, everything will come. So if there is an unwinding of OI, you cannot stick on to the OI. You have to completely on lifetime. You can analyze the market. I will show you how to do that in Sensible. So this is the risk and limitations. So the significance, the importance of the OI. Open interest is a vital gauge for a collective sentiment among traders and investors in the market. We call it as a trade confirmation as well. So it plays a very crucial role in confirming trends because if all three are going up, like the price, volume, and open interest, that is a pure bullish sign, right? You can it's a pure the data is saying you something, and you should know how to read it. So you need to understand the theoretical part thoroughly. Okay, stay tuned. I will be explaining you in detail about how you can have the real-time analytics in the OI. So liquidity and market depth is also one of the significance. Higher open interest often correspond to increased liquidity. That's it, right? So if the new contracts are being created, so there is a fresh seller and fresh buyers are being handled. So robot and strategy decision making, like traders use open interest to make informed decisions, anticipate potential reversal, and manages risk effectively. So this I will show you how you can easily what do you say, anticipate the potential reversal. So wherever the call option and put option writing is more, that is where the probability of reversals will be more, because Options sellers will be sitting on either sides, on a call side and as well as on put side. So by analyzing those historical data, you can anticipate where the market is going to close. So holistic market analysis, so incorporating open interest in market analysis after comprehensive view, allowing traders to adopt strategies and navigate the market in great precise. So we build a lot of strategies looking at the OI, even in stocks and even in index. Majorly, we use index because the open interest will be very active in options because there is a lot of volume in index options. Okay, so let me share you my screen, then we can come to the conclusion. So I will share my screen so that everyone can understand. Okay, we are already aware of this fact. So as you can see here, see I have added an indicator here for a Nifty graph. So this is a Nifty graph. Let's make it full screen. Understand? So if I have added two indicator here, the open interest and the volume. So this is the open interest of the Nifty futures. Okay. And how, see here, if you see here, the volume is increasing, the open interest is also increasing, the price is also increasing. It is a clear bullish sign. You can see here, from here, it has been moving. So here, when there is again coming to this point, yes. See, you can see here, whenever the market, the price is coming down, here, the price is coming down, the open interest is coming down, the volume also is very low here. Okay. So again, whenever the price came down, the open interest collapsed here, the volume also increased. You know, you have seen this already. So this is a bearish trend. So that is where the strong bears are in control. So immediately you can see how the open interest collapsed here in Nifty. So here again, if you see here, so it is a continuous process. As I'm showing it in 15 minutes chart, you can see it in 5 minutes chart also. See, suddenly there is a drop in open interest. Okay, so you can get this for all the stocks. So it's not like that you should only look for Nifty. You can look for Nifty, say around 21,600 call also if we see it. So let's add that and have the graph. Okay, and make it full screen so that you can all see it clearly. Okay, see here, the open interest, it is in 15 minutes. It's not that great. Open interest is increasing, decreasing, open interest decreasing, open interest. The volume is very high. That is where it has been consolidating. If you come back and see, is this 21,600 here, the open interest started rising here on 17th of January. So that is where the call writers started doing it. See, in this point, the open interest, the price falling, open interest increasing, and volume also started increasing here. So you can see the fall here. From here to here, the open interest is increasing, the price is falling, and it clearly says that it is a bearish trend. So that is how you can easily uh, analyze with the open interest. If the open interest is increasing, there are a lot of sellers and buyers in that contract. You have to see the price. So don't forget to remember this three analysis like I have shown you in the graph, right? Open interest increasing, price also increasing, and volume also increasing is a bullish. So all reverse is again a bearish or strong. So you can see here as it is, and it happens to both call and put. So you have to remember that the open interest changes for call options and put options on a regular basis. Let me take you to the sensible where you can easily analyze the data. So if you see this, so if you, this is a sensible platform where you can analyze open interest. If you come to analyze and click on open interest on all the stocks, you can just see here. So if you choose Nifty, weekly options also will have a different open interest and monthly will have a different open interest. You can always check what is the monthly positions and what are the weekly positions. As on the weekly basis are very popular, we need to understand what exactly is happening in a week. So you can choose on a weekly basis here, and you can give all or give it 5 minutes. If in 5 minutes you will get a clear picture. If you see for this week Nifty, you can see there is very less number of contracts here in at the money 21,571. There are no buyers, no sellers, very less contract, and there is a put unwinding here. You can see here. So if you see put OI chain, it is -5. Minus indicates that there has been unwinding in the strike price. So if you see here, the put OI has increased, the call OI has decreased. So that's how. Here is the call OI. So whoever sold this call option 21,400 when the market was falling, so they might have sold this call option, and as the market pulled back from 280, so this call unwinding. So call whoever has sold, they have already uncovered and they have sold more, added more puts in it. Okay. In strike wise, you can understand what are how many contracts are there. So if you see 21,600, the call open interest is more 5 lakhs and the put OI is only 93,800. So very less number of puts contracts have been written at 21,600. The call options are more. There are more addition. So don't think that if there is a seller and the buyer makes, see, buyer maybe he may be short in futures and he is buying an option. Okay, so that is how the open interest also adds. So major part what OI indicates is in the grip of seller. See, until and unless a seller comes, an open interest cannot be created. Buyer and sellers both are important. Okay, person who thinks that the market will go up will buy a call option. Market who thinks that it will fall down or it will not go beyond 21,600 or 700, he will sell the call option. He may be long, he may be having a portfolio. There, people, sellers, they don't only sell an option to make profit in options and all. They will have multiple aspects because sellers comes with a huge money and buyers is just to trade. They will, and for buyers also to hedging, buying also can be used. So in this way, if you see, there is a 21,700 has a highest open interest. There is a huge call writing. Okay, call writing is seven. You can see there are 22.46 lakh contract, and the put OI change is only 99,000. So this is for weekly, and you can check that for Bank Nifty as well. If you want to see what is the Bank Nifty, see Bank Nifty looks very bullish. Okay, by looking at the graph, just you can just if you practice this and if you understand the theory part and understand, these platforms will give you a clear indication of what is going to happen. At least, it's if not 100%, at least it gives you an insight to make an informed decisions, right? So whoever is short and in Bank Nifty, this is a time to cover. See, everyone has covered it. See, there is a call unwinding of 4 lakhs, call unwinding of 5 lakhs, call unwinding of 5 lakh. So everyone has already covered this. There is an unwinding happening in the call options and the put option added more. Which put option? 46,000. 46,000 puts has a highest open interest. That means that 46,000 is an important support. Okay. And on the call side, there is no call writing at all. So we can expect some bullishness on Monday. And if not, if the market opens with a negative sentiments, everything changes. That's why it is very important to analyze the data in the morning hours. First 15 minutes, 9:15 to 9:30, you can analyze what open interest is being built on which strike rate. Then you can enter into the strategy. See how to build a strategy. Let me show you by analyzing the open interest, because for different open interest you need to have a different strategy. If it is if open interest is giving an indication that yes, I am going bullish, don't try to be in a neutral positions, or don't create any strategy which is neutral, or don't create any strategy which is against it. So try to create a strategy which is showing, and of course you can have a mitigation on that. If for Bank Nifty, I will show you what are all the strategies if you can do with this kind of situation. And for Nifty, as it is staying neutral, I will show you what strategy you can work. See, that is how once you analyze the open interest data, understand the market trend, okay, up to 80% or 90%, I'm telling. No one is 100%. Please believe me, no one can predict 100% in this world. He will become the god if he can predict 100%. So it's only about when it comes to market, when it comes to trading in options and all, only mathematics and statistics work. So don't believe in all calls and all. Yes, there are SEBI registered analysts or SEBI registered advisors who do research like that. Research based calls you can rely on, but please don't go prey to the people who will be just making money out of the calls. They don't understand everything, so they just move the price action. That is where this channel I am giving education. Please learn and take an informed decision. So once you understand all these things, I think you'll be able to take a better decisions. And whatever we say, you'll be able to understand, right? So this was happening in. I was sending a lot of posts on the open interest, but many people, almost 50 to 60 people, 60% of the people, they didn't understand what open interest is. So that is the reason today I make myself free to make this video so that all of you can understand what the data says in open interest. Like this, there are multiple datas. Okay, so you can see here open interest versus time is also there. Okay, let's understand open interest here. Okay, if you come down, open interest versus time. So time to time, what is the open interest change in 18th January and 19th January? See, open interest is slightly increasing. So that means, and there are a lot of graphical data. So versus time also it is there on January and February expiries. So this is the future OI and this is the Bank Nifty movement. So whenever the Bank Nifty movement happened here, so even the open interest future OI didn't stop. It is still continuously going up. And in the morning, if you come here, you can just come to Nifty and you can have a multi-strike rate OI. So if you click on multi-strike OI, you will come to see what are all the major strike rates. Okay, so if you see here for Nifty, as today is a holiday, there is no selections of this. So, but you can see the most active open interest will be available here, and you can just click on call or put. Here also you will observe, see there will be an open interest rise either in call options or put options. So majorly, see if this is the case, call options and put options all are active, that means that there is a neutral market on that day. So or if there is an, if you see more CE here, so the more open interest are being added on a call option. So then you have to see whether the price is going up or down. Okay, when the call option is increasing, call open interest is increasing. When put option open interest is increasing, you know now how to analyze the open interest. Accordingly, you can just take a decision. See, if you see it's because it has to be live, the open interest, and if you want to do it on an historical basis, let's do it on an historical basis. See, if you want to see historical data, then you can change the Y here. So as 3 months contract also from January 1st, if you click it January 1st to January 20th. Okay. Call change is 3.16 crore. Put change is 2.53 crores. 29th December, the Nifty rate was 21,731 and 20th January it is 21,571. And from there, 21,500 has the highest open interest on call side and put side as well. So it is a neutral market. So if you by seeing at the January to January 20th, there is no much change here, right? So 21,550 as very lowest open rate of interest. So let's see it in 10 minutes. You can do it in live market and monthly also you can see. Monthly also, if you see all, see you can go still on December. You can just historically what has happened. Okay, you can go up to October as well. October from November 1st to January 20th. You can see the open interest created here, they are still live. Okay, so 20,500. Okay, call and put. So it is still as the highest open interest. If you see here, 19,950 or 20,000 has the highest open interest again. Highest is actually this 21,000. Okay, second highest is 20,500. So the left part here, it is a put part, right? So market is here. If the dotted line is Nifty is at 21,570. Okay, this 21,500 as an immediate support on a monthly basis. You can see if you see the historical data, still 22,500. 22,000 call option writers are intact. So there is no much change here. They are still holding strong. Here also call option, there is no unwinding 23,500. So this is the range from November to January. So by looking at this, you can always create a strategy. Okay, let me show you how to create a strategy if it is neutral and if it is directional, how you can create a strategy in simple way. So you have to analyze the open interest first by understanding the price movement, volume, and the open interest. Okay. So for that, if you want to build a strategy, you can come here, trade and strategy builder. Okay. If you come to the strategy builder, you can do it in Nifty or Bank Nifty, all the index. So let us try to build a strategy in Nifty. Okay, build custom strategy. If you see here, there is an OI column here. Either you can, many people do it on a last traded price and Greek also. You can click on OI as well. So wherever here it will show you a graphical representation that where the open interest is high and where the open interest is low. If you see here, in the call side, all these calls are waste because nobody would like to sell this on a weekly basis. Nobody, even 21,000 has some open interest. But if you see the highest open interest here, highest open interest is at 21,500, right? So 21,500 has highest open interest. If you want to add it, you can just sell it. And let's see where is the highest open interest on the call side. So equally 22,500. So you can sell this. So this will have a range of around, if you see here, 21,400 to 22,500. So if it is a bullish, so this strategy can be built in Bank Nifty as per the OI. So even for the Nifty also, it holds good. If you want to go for 21,000 also, you can sell this because more than this has an open interest. Wow. So, so as and when you go very far to the open interest, you will get more range, but you can see the probability of winning 97% or 0.6%. So one big 0.6% is also a good return for a big sellers, right? So people with huge money, they will be selling. Say if you go to lost traded price, it is only 11 rupees option and 2 rupees option. You instead of 2 rupees option, you can just go and sell this 22,000 call again. This 2 rupees, sometimes what happens, the open interest will be high because of the hedging cost as well. You might have think that who will buy 22,500 call option, who will buy 23,000 call option. Okay. For hedging purpose, everyone, there are multiple people who borrow the money, and those who have more money, they will be selling at even 1 rupee 85 paisa will be a profit for them, because selling will become free for the big institutional traders. So when you pledge any of the instrument, financial instrument, they will get a margin. By using that margin, usually people sell the options, and again for the hedging, they'll buy long-term options so that they get benefit out of it, and the risk is also mitigated. So that is how, if you are an option seller, it is very important for you to understand the open interest. Yes, of course, for option buyers also, it is very important, because if you know where the market is heading towards, you can make some informed decision. See here, if you see, and even if you sell 22,000 call option at 21, and which has the highest open interest. Yeah, I'm not looking at the last traded price. Here, if you see the open interest, that has a highest open interest, and 22,000 this one. So here the probability of winning is 93%, and you are resistance to 2.8% and up to 2.1%. So you can see, you will get 1,632 if the market closes in between this range. So to mitigate this, see, if the margin needed to sell is 1.24. So what happens? So next, to hedge it, you can buy the next highest open interest if you are not comfortable, because this gives an unlimited loss. So you can just buy the open interest which has the highest open interest to hedge your position. Here also, this 22,500 you can just buy it. So here what happens, the margin is coming down to almost 50%. One from 1.24 lakhs, it came to 66,000, right? So 66,000, the maximum loss what you can incur. See, many people say that option selling has an unlimited risk. No, you until and unless you know how to sell an options and how to mitigate the risk, people whatever they say, it is all not true. You can limit your loss by hedging purpose. So 23,000, of course, if the risk reward is very less, I understand. But option sellers, see, if you see 92% of the its probability is there, and if you see one standard deviation, two standard deviation. So you have almost this standard deviation, 1 SD says that. So if you can see here, the standard deviation gives the market expectation on how much the stock market can move. This is 66% of the chances that it will stay in one standard deviation. Yeah, I'll tell you, it works on mathematics. How to calculate the standard deviation also, I have already explained in my previous video. Okay, you can go and check it. So standard, for to calculate the standard deviation, all you need is the square root of 365 will give you, by knowing the wicks. Okay, so once you know the wicks, the square root of 365 days will give you 1 year weeks, 1 week weeks, daily weeks also you can calculate. Once you calculate the weeks, you can always deploy the strategy by looking at the open interest as well. So I hope you got clarity on what exactly is the open interest. Okay, like this, if you are bullish, see, suppose the price, everything, just remove the call option selling. That's it. You can just, whatever the CE is there, just remove it and go reversal. You can just sell. For Bank Nifty, let's see. Bank Nifty looks bullish, right? So let me show you how you can create a strategy here. So you can have a ready-made strategies here as well. Okay, long synthetic, say synthetic futures. I was telling you, you can go synthetic futures. You don't have to buy a futures, right? By paying a huge margin. So definitely you can create by using only 96,000. You can just create a synthetic Nifty. So synthetic Nifty will do like one call option it will buy and put option it will sell. So it directly works like a future. So you can just do this, or if you are moderate and if you can just go for bullish strategy and bull condor also you can keep it. So if you are losing only 5,500, and here you will get 5,900 if the market closes 4,000. You can make customized strategy as well. So let's clear all these things, clear new trades and book. Okay, on last traded price and open interest also you can do it. Open interest, let's see where is the highest open interest. First understand where the bank nifty is. So it is at 46,000. 46,000 call and put has the same highest open interest. If you see here, here also the same bar. This bar, the green bar is about the open interest. So even if you go for last traded price, it will follow. You don't have to really go and see and open interest. I will show you how to read the open interest as well. So increase or decrease, you will have to see it here. So if you see the open interest here, 46,000. So here is almost three-fourth, yes. In this way, what you can do is if you are bullish, you can just sell the second highest open interest and buy this kind of strategy where the probability is 83%. So you can sell the 45,500 put. See, this you should do it when you get a confirmation from all the three sides. When the price is moving up, volume also moving up, and open interest also increasing, then you can create this kind of, this is called as lizard strategy. Okay, where see up to 45,400 you will not lose anything, and if it is above 45,400 you will gain, and from here it will keep gaining. And if you want to still reduce the margin, you can just go and buy the second highest open interest. Okay, you can just go and buy 44,000 put. So from 34,000 itself, for 34,000 you can create a strategy which will be a break even at 45,450. Even if you buy it or not buy it, the it slightly 20 rupees change. So just for the margin benefit, you can just go and cover your this one. Maximum loss will be 29,000. Okay, that is not that, it is when it comes to here. See, it will come to here, here, here. By that time, you should transform, you should exit. As soon as it comes to 45,400, this is the exit point. You should not carry, because the open interest by that time, there will be more call options returns, and the put options open interest will be increasing. At that point of time, you are not supposed to hold this, you have to reverse it. So that is why it is very important, guys, to check the open interest regularly and understand it better. If you do, if you are not having any sensible this one also, you can go to NSE NSEindia.com as well. So NSE India also will have the open interest. If you go to market, so here is the option chain. Option chain, if you click it, so you can see here the whole option chain is here for Nifty. So for Nifty, and you can see here where is Nifty 21,500, right? So let's come here and see. This is the open interest, change in open interest, volume, implied volatility, last traded price, percentage change, bid quantity. You will get all the data. To be frank enough, all this data is pulled into Sensible, and NSE gives data to analyze in different platforms. If you are not aware of any of the platforms, Sensible, Lobstra, or a lot of platforms are there nowadays. Every broker is giving the option chain data. If you don't have any other things, come to NSE, and in NSE you will find all the data in one place. Okay, you can see. Let's understand 21,500, right? 21,500. Which one has the highest open interest? See, if you see here, 58,000 contracts are there. So 19,000 put has the highest open interest. Let's see nearby data. 20,000, 21,000. Yeah, here it is 21,600. See here 98,000. 1,31,000 contracts. So this has the highest open interest. If you see here, 1 lakh contracts are there at 21,500. So on the other side, if we see here, so here 1,56,000. You can see here, this is the highest open interest. If you see here, yeah. See, 22,000, I think this is for hedging. They have bought it. 22,300 as also highest open interest. 22,500 as well, also having a 9. So 21,000, it has the highest open interest of 1 lakh 56. So 1 lakh 56 here and 1 lakh 31. 21,500, 21,700. So 21,500 will act like a support and 21,700 will act as a resistance. So you may see a sharp fall at 21,700 and strong bounce back at 21,500 because there is a lot of contracts. And when it comes to those strike rate, you have to check whether there is an unwinding or whether there is an addition of open interest. If the price started falling, okay, the volume increased, the open interest also started increasing, so that gives a bearish sign. So to keep everything in mind, so that is very important. So if you understand this, you see these are all the uh, platforms where you can check what is the open interest. See, 21,000 is also having 1 lakh 36 contract, and what is the change in OI, whether there is an addition. See, there is an addition of 18,493 contracts, and here there is an unwinding. So unwinding is seen at 21,000. So in lot of options, if you see for every 50 rupees, there is a strike rate, right? So you have to check at only the major numbers. Don't try to analyze all the data in detail. It's not required. What you require is which strike rate is having the highest open interest, which is increasing, which is decreasing. In that is the way we use Sensible or Opstra or Allies Blue also is giving some good data. There you will see the live changes what it is happening. So that is how you have to look at the data. See, even see these people, just imagine if market comes to 21,700. See here 41,000 contracts have been added. So it's a huge. Okay. So 21,700 has the highest open interest here. So that is how in NSE you can always see this is call side and this is put side. You need to understand this before going call because in Sensible this side it is put and right side they'll give a call, and here in NSE website you come here for a heading. So this is call OI and this is put OI. So by understanding this, you can see put OI, there is call writing, put writing, highest open interest is here. So 21,000 is a strong support here, and here 21,700, 21,000, 22,000 is also having an highest open interest. Okay, 1,56,000. So here is that is how you can analyze the open interest. So please comment it on the YouTube channel if you want me to explain. You can create a lot of strategy by using open interest. So selling strategies also you can create, and buying strategies also you can create. If I continue to do that, the video will be very long, and it takes a lot of time also to explain how to build a strategy, how to automate a strategy by using OI. Because in this today's era, there are multiple strategies where you can build if there is an OI change. Because for human beings, it is very tough to analyze all this data and come to a conclusion, right? So those were the days where we used to have this mathematics and calculating. Now, by using the technology, you will get the data right away in a fraction of a second. And there are many platforms which can give you analytical data, and so that you build a strategy and be tension free, emotion free trading. That is what you can do until and unless you understand in-depth knowledge about everything about the open interest, about the technology as well. So then only you can be a profitable trader. So that's it for now. I hope everyone understood the open interest part. So let me show you the final conclusion. Okay, the final conclusion would be, I think many of you know already, market insight, open interest provide a deeper, right. The conclusion says that deeper understanding of the market sentiment and strength going beyond the simple price movement, right? So rather than going only on a price movement, understand the open interest, where exactly the call writing and put writing is happening in, so that on the date of expiry, everything you might have seen on the expiry day, right? So a lot of price movement happens, even though the market spot price is at 47,000. Say if the market is at 26,000, 26,000, the call option may be spiking 20 rupees, 30 rupees, and all of a sudden it will come to zero. So that is because of the open interest, highest open interest. If it is the call short have been done, and on the last half an hour, the market takes the weighted average movement of the Nifty or Bank Nifty. So many people doesn't know. People will be keep buying that 2 rupees will become 200 rupees. No, every day it will not become like that until and unless there is a huge price movement, volume movement, and open interest movement. This will not happen. If that is going to happen, you can easily get that. Okay, static decision making. Traders use open interest to confirm trends, predict reversal, and effectively manage the risk. So liquidity indicator also, we call it as higher open interest often correspond to the increase in volume. So increase in volume means increase in liquidity, smoother trade execution. So when you have more number of people coming into the market, buying and selling, or happens in a very fast way. So that is where if the open interest is high, the execution of the orders will be very smoother. And of course, the buyers, that is where they lose heavily, because without understanding the wicks, when the price is moving up and everything is moving up, people when the wicks is high, you know how the put options will be on a higher side. They still tend to buy put options, expecting market to fall, because the data has already given information. The pro traders are already into the trade. They are sticking on to their plan. You people, like, without having a proper knowledge, if you sit and emotionally think and pray God also, it will not come down. So in the market, only statistics and mathematics work if you are a trader. If you are an investor, have a proper mindset, have a long-term goal, invest in fundamentally good stock, and follow some technicals, understand what is happening in the stocks, and hold on to enjoy the dividends. Don't sell your stock. You can always pledge and take a married put kind of thing if your portfolio is good. That is how you have to build your portfolio. Sentimental analysis, continuous learning, as it is conclusion in the conclusion. Continuous learning is very important, and continuous monitoring of open interest is also incredible. Recognizing the risk and limitations of open interest is crucial. Continuous adapting strategy for effective market navigation. As I told you, sometimes even after 3 o'clock, all of a sudden the call writers will vanish. They just, because it is all algorithm plays. See, if for FAs, if they want to convert their short positions into the long position, it takes a second for them. But for you to make that happen, you have to, because if you are carrying a lot of losses, you may not do that. All of a sudden, if the price movement starts and the volume increases, they will unwind and sell the put. Okay, and they will be buying the calls, but you will be still stuck in the trap of selling a call option. Okay, so that's it for now. I think I have cleared many of the doubts and how you can utilize the open interest. So major thing to conclude also, this is very important. So price, volume, and open interest, this is trend. So if you understand this simple thing, whatever you learn today in details, that will be not like you should understand how it works. Until and unless you understand all this theoretical aspect, you will not come to know this analysis, because everyone, if you ask anybody, oh, they trade this, but knowing only this is not enough. Like, you need to understand how it changes, why it changes. See, the most important choice is this: how open interest can remain the same, volume increases, right? And you can do it in the graph as well, and you can, to simply analyze the trend, you need to have these three things in very crucial manner. Remember this: price, volume, and open interest. This is a correlation. Okay. Bullish will get exhausted when the open interest is decreasing. Yes, because when the open interest is decreasing, why would an option? Because open interest decreases when there is an unwinding, right? Unwinding of a call option or unwinding of a put option. So weaker trend. That's how it is. Even it is bulls becoming strong because open interest has already collapsed, volume also collapsed, price also collapsed. They will become at that time, the fresh open interest will be created. So that is where wills become very strong. They start selling the put and the call as well, depending upon the range. And that is where, again, it will start moving on the other side. So if the price is falling, volume increasing, open interest is increasing, that is a bearish sign. Please remember very carefully this: all three has to be green for bullish, and if price is falling, these two are increasing, that is a very bearish trend. This is the very perfect sign for a bearish trend. If open interest increasing, volume is increasing, and the price is falling, I have already shown you in this graph like how whenever the market fell down, the volume increased, the open interest also decreased, the price also falling. Okay, but this was on the Nifty, because if you see any option strategy, the open interest of put option might have increased. So it depends upon which strike rate open. Every individual strike, if you see, every individual strike will have a different open interest. So that is where in Nifty it is always advisable to go with an 100 rupees gap. See, if it is at 21,500, 21,500, 21,400, 300, 100 rupees gap will have more liquidity. This 50 rupees gap will not have higher open interest because nobody trades. It will be illiquid. So only for hedging purpose may the open interest will be created. Please take a note of it. Thank you very much. That's it for now.